Today I'm over on the mainland here in Miami, and we passed by this area one time before. They got like this little private marina along this inlet here, so we'll check out some of these boats and we'll wrap around and walk on a new street that we've never walked on before. I saw some houses for rent and for sale over there, so we'll take a look at some new stuff today, see some water, see some boats, and talk about the next boot to drop. And that is very likely to be the upcoming credit crunch, guys. Now, what is a credit crunch? What am I talking about? Well, basically, in simple terms, it means the banks are very likely to start tightening up on how much lending they're likely to be giving out in times of crisis like this. And so when that happens, it can have a huge impact on the economy from all different angles. Imagine you want to go buy a house. Well, now you're having half the options in terms of mortgage lenders. You want a new car? There's half the options for people to get a car loan from. Oh, you want to finance that TV from Best Buy now? Well, maybe you can't get that option anymore because lending is just starting to dry up. And that's basically what a credit crunch is. And just based on those three things right there, you can get an idea of how much of an impact that is likely to have on the economy. You're talking about people not being able to buy things because they cannot access credit. And when you can't access credit, everything comes to a screeching halt unless people have the cash to buy things, which we know that they don't. Otherwise, credit card debt wouldn't be boiling over into an all-time high. Same thing with the HELOC loans. That's basically at an all-time high. Why would everybody be borrowing all this money if people had the cash, right? I'm pretty sure we can all guess by now what is spurring this potential credit crunch that's coming for us, and that is the bank failures. And here's the crazy thing, guys. Listen to this. At this moment, it is still undetermined just how much money has been leaving all the regional banks and piling up into the big banks. Like, for example, when Silicon Valley Bank went down, $42 billion left that bank in just one day. And that's just one bank, okay? So we have no idea how much money people are actually pulling out of regional banks and putting into the bigger banks. And as they do that, it's very likely to cause the smaller banks to fail. And what it's also going to do is it's going to put a higher risk factor on the bigger banks. And this recent report that I ran into today says that even a modest exodus from mid-sized institutions could depress lending and sap the economy's forward momentum just as the Fed's year-long series of interest rate increases starts to bite. As customers withdraw funds, regional banks will need to pay more for funding, either by raising interest rates on deposits or by paying higher lending costs in the wholesale market. So you can see that this whole situation is very bad for the small banks. It might sound great for the big banks, puts a lot more pressure on their systems as well. So really, this isn't good for anyone. And the thing is, we've been seeing small banks disappear for a long time. To put things into perspective, back in 1994, there were about 10,000 different banks in the United States. At the end of 2021, that number has now sunken down to 4,237. So less than half the banks exist than that did 30 years ago. Here's the problem with the big banks collecting all these deposits now. You have JP Morgan, whose assets total about 3.8 trillion right now, which is larger than the entire French economy. So you're talking one bank has more assets than an entire country right now. So do you think that's healthy? What if JP Morgan runs into trouble? What happens then? You know, is there going to be enough money to bail out, something like this? They can't keep printing these trillions of dollars, guys. I mean, sure they can, technically they can, but it's basically the death sentence for the United States if they continue to do this. Like I've been mentioning a lot lately, and it's something that I've been thinking about a lot lately, is we are facing a tremendous headwind right now when it comes to the BRICS nations starting to team up against the US, okay? They're tired of us sending them our toilet paper money and would rather have their economy backed by real assets. We're talking gold, silver, and commodities. That's what they're doing. Meanwhile, over here, we're just printing a bunch of funny money that's backed by nothing, and the other countries are getting tired of it. And honestly, I'm getting tired of it as an American, you know? That's why I tell people, you know, go on your own gold standard, you know, back your own wealth with gold and silver. But hey, you can do whatever you want. And don't get me wrong, guys. I think it's smart to have other things too. Guns and ammo, food, water, supplies, you know, to last you a long time in case something happens. You know, it's always good to have stuff just in case. That's basically my motto. You guys have heard me say before that, you know, I was a Boy Scout when I was younger, and we always learned to be prepared. You know, basically you prepare for the worst and hope for the best. And by doing that, you can almost never go wrong. But here's the other reason why these small bank failures are such a big deal, guys. These small banks, they account for 2/3 of all commercial real estate loans. So imagine if a bunch of these small banks go under, how difficult it's going to be moving forward for commercial real estate. And as these smaller banks pull back on making new loans, another thing that it can do is cause the economy to slow down even more for borrowers who are in a lot of debt, who need to roll over their debt. And they're just going to have less options, if not no options available. That could cause major defaults in the credit system. And if you think this is bad right now, you haven't seen anything yet. And not only is this consolidation of wealth and assets into the larger banks bad for the economy in general, you know who else it's bad for? It's bad for us, you and me, the small individual, because the more wealth and the more assets these banks hold, the more influence they also hold over our local governments or the national government and politicians in the form of lobbying to get their way when it comes to different things in the lending and banking industry. And you know that these big conglomerates do not have our best interest at stake. They're looking out for their bottom line. So as you see more of these smaller banks fail, it just means bad news for all of us. And it's almost guaranteed at this point that there's going to be more bank failures. In fact, Michael Burry, the big short investor, he came out this week and said that First Republic is the number 3 bank that's most dependent on wealthy customers and has a ton of uninsured deposits there. And the other banks that are right behind them are banks like Co-America and US Bank Corp. About 60% of their depositors are uninsured right now, according to Michael Burry. So if you don't think that's a problem, it's huge, guys. It means there could be more bank runs on these banks, and what's going to happen then? Is the government and the Fed going to bail them out too? Well, that's yet to be seen, but I wouldn't be surprised. I feel like on these walks, we basically never see any listings that just make sense anymore. Here you have a rental listed at $5,700 a month, and it's been on the market for 123 days. That's about 4 months. And the last time they rented it was January 2022 for $5,520. So that's only about $200 away from where it's listed right now. That's not a very big gap in price. So obviously it needs to come down. They just need to lower it to the point where someone will rent this house. I mean, having it empty for 4 months, you already lost over 20 grand at that rental price. Crazy. Now, one thing I've been seeing a lot of people mention in the comments section is about QE and how it's back because the government's balance sheet has been going back up, and that it basically erased quantitative tightening that they've been doing. And a lot of people think that this means that the housing market's going to shoot back up to the moon, guys. So far, we haven't seen that yet, but here's my take on it. I don't believe that that's going to happen, and here's the main reason why. This quantitative easing that they did, this money is not falling into the hands of the everyday American like what happened during the pandemic. Like, for example, back then, when we had all this QE and the money printing, you literally saw money going to people and to businesses in the form of the stimulus checks and the PPP loans and the different small business loans and grants that were available back then. But this time around, even though that they did technically print money, that money is not getting into the hands of you or me. This is all going straight into the banking system in hopes to curb further collapses. So I don't think that this round of QE that they did is going to have an impact on the housing market. Now, I could be wrong. I am not a studied or seasoned economist by any means, but I'm just a regular Joe paying attention to what's happening on the daily. And from what I can tell, I don't think this is going to have an impact on real estate, because we still have a lot of problems facing real estate when it comes to sellers feeling stuck in their homes because they have good mortgage rates, when it comes to the high interest rates knocking a lot of buyers out of the market, and inflation still eating up a huge chunk of people's budget that they otherwise might be able to use to buy a home. I think when you guys look at listings like this, you can quickly realize why I don't want to work as a real estate agent anymore, especially here in Miami. You have a house here that's been listed for sale for about 6 months. They've only taken a $40,000 price cut and still no sale. So when you're an agent and you list a property like this, you're just wasting your time coming to showings, showing everybody the property, getting no offers or not getting the offers that the seller wants, and you just end up wasting a ton of time and very likely not getting paid. And of course, because I'm a real estate agent here in Miami and people know that I'm down here, you guys ask me all the time what I think is going to happen in Miami, what I think is going to happen in Florida. Well, let's take a look at the most recent market report from what is happening here as of February, okay? When we look at the single family home closed sales, they're down significantly, down 21% in fact, okay? And the amount of homes that people are paying cash for also down by 27%. Funny enough, the median sale price is still up year over year at a time when now nationally home prices are falling year over year, guys. So far, as of March 2023, Florida has been pretty resilient to the housing market crash. But as you guys can see just by the top level figures here, that things are slowing down significantly. You're not seeing the massive gains that we were seeing before. I mean, look at that. You have a 3.5% growth in median sale prices here in Florida. That's for the whole state, okay? And you can also see by this chart that the amount of money that has been flowing into the state is starting to slow down as well. And if you ask me, this has been the key reason why home prices have continued to go up so much here in Florida. I mean, just look at this, guys. February 2022, you saw 12.9 billion flow in, but now in 2023, it went down to 10.3 billion. So you can see it's starting to slow down. At some point, this is likely to reverse. Florida's just behind the curve when it comes to, this housing market crash, and just hasn't been affected by it yet, like we've seen with so many other states and municipalities right now. And then you get ones like this that just crack me up, really, because you have a property here that was listed for sale back in September last year for 2.9 million, and then they took it off the market that same month, but they still have a for sale sign in the front, probably hoping to get someone to call and get some idiot to come in here and pay $2.9 million for this house. In what world is that going to happen? I guess probably only the fantasy one. But as you will notice from this, that new listings are down as well. New listings are down 12.6%. The pending inventory has also had a huge drop as well. You're talking almost a 21% difference year over year. But the thing is, guys, this is the indicator we need to keep an eye on, and this is what I ultimately believe will lead to lower home prices even here in the almighty Florida, and that is inventory, active listings. Look at that. It shot up 131% from February 2022 to 23. Look at that. 26,000 listings up to 62,000. And mind you, this is only single family homes that we're talking about here. We'll cover the condo market here in just a minute. And as you guys can see, the month supply, okay, that has increased 200%. It's almost at 3 months right now. And the long time average for a healthy housing market is 6 months of active inventory. So if inventory doubles from where it is right now, which is highly likely to happen given how pending sales are just completely falling off a cliff right now, that will bring us back to a balanced housing market here in Florida, and buyers will finally start being able to get homes for the right price. Wow, look at this. There's your dream home, guys. Feel free to place an offer. And that's the house right across the street. I'm sure it's lovely for them looking at that. They got this beautiful home, and right across the street is this ghost town dungeon. Well, let's take a look at condos. Closed sales down 30%, guys. All right, the amount paid in cash down 31%. But the median sale price is up 8.6%, which is unusual in the sense that we have seen condo prices appreciate on a year-over-year basis higher and faster than single-family homes. That's pretty atypical. In the past, we've always seen single-family homes go up in price higher and faster than condos, but we can see that's starting to slow down now that they've just become unaffordable for many people. But the dollar volume that's flowing into the state buying these condos is also down by almost 29%, as you guys can see. And it is taking significantly longer to sell them. Median time to get a home contract is up from 14 days to 34. Pending home sales also taking a nosedive in this department, down 27.5%. And here you go, guys, active inventory is up 106%, basically double from where it was a year ago. And the month supply is higher than single family homes. It's at 3.2 months supply, up 166%. So what this latest market report tells me as a seasoned agent here is things are about to get a lot better here for the home buyer in Florida. And this is just the beginning of 2023, guys. Everything that we've been talking about with this banking crisis, the potential credit crunch that is right around the corner, interest rates where they're at, is very likely to see all of these numbers increase when it comes to days on the market, the amount of active inventory. You're probably just going to see everything we just talked about improve from the buyer's side of things. But honestly, I think this is great news for sellers as well, because you have so many sellers feeling locked into their current home because of where interest rates are at and not feeling like they can sell without getting ripped off on their next home. As prices come down, then that might be a push for more sellers to actually sell, which sounds counterintuitive, because why would sellers want to lose money on the sale? Well, it's not necessarily that they want to lose money on the sale, but if they bought, say, 5-6 years ago or more, they're probably not going to lose money. They're still going to turn a healthy profit, and they'll have plenty of options to choose from when buying their next home. And the interest rates will become less important if the prices have come down enough. So overall, this is a healthy thing for the market right now. Now check this out. Rental prices have become so ridiculously unaffordable in New York City that the landlords there are now resorting to a rental insurance option for tenants there to basically fill up units, because they have been having to deny so many people from getting a place over there to the point where they have to turn to options like this in order to fill up their units. Otherwise, nobody can actually afford it. The average annual rent for a studio apartment in New York City is up to $3,200 right now. And in New York City, they want your income to be 4 times the monthly rent price. Well, that means $128,000 per year. A lot of people just don't make this kind of money, even in New York City. And it's getting so bad to the point where the denial rates for new tenants that are applying for these units there has literally doubled in 1 year. It used to be 30%, now it's 60%. But it's not just here in New York where the denial rates have been going up. They're also seeing it in Miami, here as well, and Boston. These are the top markets for people getting denied because they just don't have the credentials to rent at these prices. So what's happening? Are they just leaving these units empty then? Not so fast. Enter the insurance company called the guarantors, okay? This is the country's largest residential lease guarantee company. The firm currently provides over $2 billion in renter coverage, and they insure everything from security deposits to future rent payments, as well as just regular renter's insurance as well. And basically, this insurance company uses all different types of algorithms to determine any one potential tenant's risk of defaulting on their rent. Probably use all sorts of things like their credit history, payment history on things. That's why I tell you guys, if you have shady credit, get it fixed, because I almost can see a future where landlords are going to start requiring tenants to have this. You already see a lot of landlords today require renters to have renter's insurance, and then if this becomes more of a thing where people just can't afford the rent but landlords need to get the units rented, then they would be very likely to turn to this as a future requirement for tenants. And guess who pays for that? You do, as the tenant. And depending on how much you're willing to pay for insurance, this company will guarantee anything from a 1-month security deposit to the full value of a 2-year lease. So they're very flexible on the coverage terms that they'll offer. From what I can tell from checking out their website is basically they offer plans for both tenants and landlords. So whether or not landlords will force tenants to pay for this is too early to tell. But I wouldn't be surprised, guys. You have to be ready for everything. And listen, that's where having good credit comes in. If you don't have good credit, then you won't even be able to qualify for something like this, most likely. And if you do, your insurance premium is likely to be a lot higher than somebody that has their credit all established and have always made their payments on time. And one more thing is I see some people from California asking me, you know, when is the California housing market going to crash, considering that's basically one of the most expensive places to live in the entire country. California home prices now have fallen 18% across the board in the whole state. Now you're talking statewide, okay? So these are statewide statistics, so things could still be different in your neighborhood. If you live in a highly desirable and affluent area, this might not apply, okay? But statewide, prices are down 18% from the peak of last summer. Sales are down 33% in California, and things are so slow that California has seen the 3rd slowest selling season in February since 1990, guys. Think about how long ago that was. I mean, I was a little kid in 1990. And that's how slow it is. That's how much things are changing right now. And people need to look at this and recognize how big of a deal that all these massive changes that are happening right now really are. And out of 8 of the last 9 months, home prices have been falling in California. The California median home price is at $735,000, and that dropped 2.1% just from January to February. And even though prices have been coming down pretty significantly there, it still hasn't been enough to get a lot of people in California to go out and buy. So you need to recognize at the peak of the market, median home price in California was $900 grand. Well, now it's down to $735, and this housing crash is just getting started, okay? So imagine where it could be in a couple more years from now. I think you're gonna see, you know, California become way more affordable in the near future as more people leave the state due to the insane tax situation there and the homeless problems they have and everything else. So you have people fleeing the state year over year at the same time when the market is going down. This is good if you live there and you just are feeling priced out of housing over there. And if you just want to get a reassurance of how significant this is, in 1991, prices fell 6% in 10 months, and over a 69-month period, they went down 20%, home prices there. Well, they already went down 18%. So that almost beats that entire record in just the last 8 months, okay? And in 2007, last housing crash, prices fell 30% in 10 months. And in some areas, it went down 59% in 21 months. So California could be looking at a huge housing crash right around the corner as things continue to develop. If you guys enjoyed this video, make sure you click the bell notification down below. YouTube will alert you every time I post a new video. And if you don't want to wait, check out my next one on the screen right over here, and I'll see you in the next one.